السلام عليكم. لا تنسوا الإعجاب والاشتراك في القناة تشجيعا لنا لمزيد من العطاء والتألق.
In this episode, we are going to learn all about trading pullbacks. A pullback to an area of value is one of the best techniques when trading in the market direction. And it is also one of the safer techniques because of the confirmation that it gives. We will discuss the pros and cons of trading pullbacks, and we will talk about the likely places on the chart where the market will pull back and how to approach your trades. So if you are ready, let's begin. What actually is pullback trading and why does it work in the market? Now, a pullback is when the price temporarily moves against the underlying trend in the market. For example, in an uptrend, a pullback would be a move lower, or we can say it is a corrective move. On the other hand, in a downtrend, a pullback would be a move higher. So in essence, what you are trying for pullback trading is to buy the dips in the markets or the retracements to a critical level or the corrections in an existing trend. For example, the price breaks out of the resistance level with a strong candle and then it retraces or pulls back or tests the resistance level and then move up higher. Another example would be if the market is trending higher. You are always looking to buy the dip or to buy the retracement or to buy the pullback so as to buy at the least possible price. And in case of a trending market, the reason why pullback trading works is because when the market is trending, it does not go up in a single straight line. Instead, in an uptrend, you can expect to see a series of higher highs and higher lows. So as a pullback trader, what you are trying to do is to time your entry on the pullback or the retracement or the correction. So you are basically entering the trade as the market trades at lower prices during an uptrend. As a pullback trader, you are trying to take a trade in the direction of trend, but you look to enter when the market is sort of going against the trend on the retracement or the corrective move. But you are still trading in the direction of the trend. And the reason for pullbacks in the prices is simple. It is due to the short-term profit booking by some traders, which causes the prices to dip lower. Now let us move on to understanding the pros and cons of pullback trading. We will start off with the positives. With pullback trading, you are basically buying low and selling high. For example, if you are trading pullbacks in an uptrend, you are basically buying at lower prices and the intention is to sell higher. And if you are selling pullback in a downtrend, you are basically selling at higher prices so that you can buy back at lower prices. And the second thing about this is that it is actually easier when it comes to your trading psychology when you're trading the pullbacks. The reason being, you are basically trading from an area of value because buying low and selling high is something that we are all accustomed to even when we start learning about the markets. Think about it in terms of a small business. Basically, what we want to do is to buy at lower prices and then sell at higher prices. Now we will talk about the shortcomings of trading pullbacks. Now the downside of pullbacks is that you might miss the move more often or not. Let me explain. For example, we know that an uptrend consists of a higher highs and higher lows. Let's say the price is pulling back or retracing back right now. Assuming that you are hoping the prices to retest back to the lows onto the trend line or the moving average. But what happens in the market is that the price does not pull back deep enough. And then it broke out higher without you being able to take an entry. So it ended up causing you to miss the move. This is the biggest disadvantage when it comes to trading pullback, which is that sometimes you actually miss the move while waiting for the price to come to your desired level. The second disadvantage, or maybe I won't call it a disadvantage, is that pullbacks are not suitable for impatient traders. Now, if you are an impatient trader or you have no patience to wait for a pullback, then this strategy might not be your piece of cake. Now that we have understood about the advantages and disadvantages of a pullback trade, let us learn how to approach a pullback trade. So there are a few things to look for on trading a pullback. The first point is to identify the market trend. Now, the first and foremost thing that you have to figure out while you trade pullbacks is to find the existing market trend. You must have a trend in the market because most often you will encounter a pullback opportunity when there is a trend in the market. And more importantly, make sure to trade in the direction of the trend and not go against the direction of the trend. Now, I'm not saying that there won't be any pullback opportunities if the market is not trending or if the market is in a range, but instead, the probability of getting a pullback setup is higher when there is a trending price action. And most often or not, during a range or consolidated price action, the market tends to give explosive breakouts where the chances for pullbacks are lower due to increased interest and participation by the market participants. Now, the second point is to identify an area of value. Here's the thing, just because the market is in an uptrend doesn't mean you want to blindly enter a trade. Instead, you want to be trading from an area of value. An area of value could be any of these, including a swing low or a swing high, a support or a resistance level, a trend line or a moving average, etc. These are all potential areas on your chart where buying or selling pressure could step in. Now, the third point to consider is to look for an entry trigger or an entry area. Assuming that the market is trending higher and it has made a pullback towards an area of value. But this does not mean that we can blindly hit the buy button. As a pullback trader, you want to look for specific entry triggers to let you know that the buyers are stepping in, or to make sure that buyers are in control and they are about to take the prices higher. The entry trigger could be as simple as reversal candlestick patterns, which may be bullish hammers or bullish engulfing patterns, etc. So that's an entry trigger for us to time our pullback to get on board the trade and to join the existing trend in the market. Now, the fourth point is setting up your stop loss. Since you are trading pullback, the most important question is, where do we set our stop loss? Logically speaking, if you are trading pullbacks on a uptrending market, then your stop loss should be below the lows of the pullback. So in case if the market is on an uptrend and you have kept your stop loss below the swing low, this means that if the market corrects or retraces and breaks below the lows of the pullbacks, it tells you that this pullback has failed and you want to get out of this trade. So in order to be safe and not hit your stop loss before the pullback finishes, you will have to identify the lows of the pullback and give some buffer below the lows. For this purpose, you can either use the ATR indicator or you can even set it based on your risk-taking ability. Let's take a look at the ATR method briefly. Let us say the low of the pullback is 100 rupees. And let us say you pull out the ATR indicator and the average true range of the market is rupees 5. You can simply take rupees 100, which is the low of the pullback, and subtracts rupees 5, which is the value of the ATR at that specific period. Now your stop loss turns out to be rupees 95, which will set a small buffer below the low of the pullback. Now a similar approach can be taken in case if the market is on a downtrend. And the final point is setting up your targets. Now where do you take profits? Let's say you are trading in the direction of an uptrend. What you can do is to reference the extreme swing high to take the profits. When you are trading pullbacks during an uptrend, you are buying the dip when the market has retraced against the trend. If you look prior to the retracement, you should be able to identify a swing high on the chart, and this swing high could be a reference point for you to take the profits. Now, if you are looking to buy a pullback and you went long and the market is moving favorably in your direction, you can look to take the profits just before the swing high or before the nearest resistance if you are an intraday trader. And you can ask me, why not after the swing high, or why not at the swing high, or why not at the resistance level? The simple reason being, swing highs and lows, supports and resistances are not specific levels on the chart. Instead, they are areas or zones on your chart. This means that the price could come close to the swing high but may not be able to reach the exact price point and then start to reverse from there. So if you don't want to watch your open profits come close to your target only to do a sudden reversal and then hit your stop loss, what you want to do is to set your profit target just before the recent swing high or the nearest resistance level for this example. Now that we have learned how to approach our pullback trades, let us move on to the different ways of trading pullbacks successfully and how to employ the entry and exits in the right manner. Starting off with breakout pullbacks. Breakout pullbacks are very common and probably most of you have encountered them. Breakout pullbacks commonly happen at the market turning points. That is when the price breaks out of a consolidation pattern or a range. Now some of the most popular consolidation patterns includes the head and shoulders, the wedges, triangles, rectangles, etc. So the question that naturally comes up is how to trade the pullbacks. Although there are many ways how you can approach the pullback trading, I will talk about two main concepts of pullback trading during a breakout. Now these principles can be applied to all other pullback scenarios that we will discuss along. Let us take the case of an aggressive trader. Now the aggressive trader waits for the price to come back to the pullback area, which may be a support or a resistance level, a trend line, a moving average, etc. And he enters the trade right away when the price pullbacks to the level. Let us say the point 1 marks this approach in the scenario of a breakout and pullback. Now there are a few more points that you need to consider when choosing such an approach. Using an aggressive trade entry, you may be able to enter at the best possible prices, as this point can often mark the extreme point of the correction wave and the pullback phase. So the potential reward to risk ratio is highest following such an approach because the stop loss can be placed very tightly. But the major drawback is that you enter a trade against the price direction without any confirmation. So the price could easily go against your trade. So such an approach can therefore have a lower win rate or a lower probability of success. But the higher reward to risk ratio may offset it though. But I wouldn't go by this method. Me, being a conservative trader, waits until the price continues the trend structure and breaks over the pullback. Now with this approach, the trader goes with momentum and confirms that the trade is in the desired direction, unlike the aggressive trader's case where there was no confirmation of the trade direction. Now the conservative approach or the conservative entry happens later and therefore the potential reward to risk ratio is smaller. If you ask me, there is no right or wrong when it comes to trading, and it all comes down to your personal preferences as a trader. Now talking about the stop losses, you have to place the stop loss below the pullback low in case of a breakout on the upside, and make sure to add the suitable buffer based on your risk potential, or you can even use the ATR indicator to do the same. It is always better to stay cautious as to not move your stop loss to break even, because this is a very dangerous and unprofitable thing to do. And the reason for this is that pullbacks happen so often in the market. After a long uptrend, the market stays in a range between defined levels. Now many traders use the levels to time their breakout entries. In this case, we are anticipating a breakout on the downside, and most traders would use the support level to time their breakout entry. But where they go wrong is that they move their stop loss to break even too soon, and when the breakout pullback happens, they will get kicked out of their trade just to see the price return in their anticipated direction, but without them. Finally, the targets can be the next potential resistance level, or place a suitable target based on the type of consolidation pattern the market was in right now. Be it a wedge, be it a triangle pattern, be it a rectangular pattern. Use a suitable target based on the consolidation pattern formed in the market. Now the second way of trading pullbacks is using horizontal steps. Now the stepping behavior can be observed during many trending phases in the market. During the ongoing trending phases, the price will often present those stepping patterns. This pullback approach is a great addition to the previously discussed breakout pullback. The breakout pullback happens very close to the market turning points. But if the trader misses the initial entry opportunity, the horizontal steps can allow the trader to find alternative entry scenarios. It also helps the trader to enter a trade even if the pullback does not form a swing low touching the trend line or a moving average. In case of an uptrending market, the entry in this case would be during the retracement from a swing high level to the previous swing high levels and using confirmation candlesticks like bullish engulfing or hammer patterns for the trade entry. And if you talk about the stop loss for the trade, it would be suitable to place the stop loss below the step pattern or the swing low with a suitable buffer depending on your risk appetite. Further, a trader could simply choose to use the stepping pattern as a trial stop loss behind the trend in a much safer way. In this case, the trader waits until the price has completed a particular step and then trial the stop loss behind the last pullback area. And because of this, the stop loss is protected and it is not very vulnerable. A target in this case would be each of the swing high levels as the price moves in your favor. Now the third idea should have been trend line. We know that trend lines are famous pullback tool, but the drawback with trend lines is that it takes longer to get validated. As a thumb rule, we all know that a trend line requires at least 3 contact points to get validated. You can always connect 2 random points, but only when you get the third contact point, you are really looking at a trend line. Trend lines can work nicely in addition to other pullback methods, but as a standalone method, the trader will miss many opportunities as the trend line validation takes a long time. So instead of using a trend line, we can use the moving averages for pullback trading. And without any doubt, moving averages are amongst the most popular tools in technical analysis, and they are used in many ways including trend identification, and you can also use them for pullback trading as well. You could use a 20 period, a 50 period or even a 100 period moving averages. It does not really matter, and it comes down to whether you are a short-term trader or a long-term trader. Now, short-term traders generally use shorter moving averages to get the trade signals quicker. And of course, shorter moving averages are more vulnerable to a lot of noise and wrong signals. And longer term moving averages on the other hand moves slower, and so they are less vulnerable to noise, but you may not get much trading opportunities as in case of the short term moving averages. So it is up to you to weigh the pros and cons of your own trading style. For the purpose of this example, I will use a 50 period exponential moving average and the price is in an uptrend. Now here we can see that the prices are correcting and reaching the moving average, and it is actually respecting it. The entry in this case would be above a rejection candlestick from the moving average, like a bullish pin bar or a hammer and bullish engulfing candles. It shows that the buyers are willing to buy at higher valuations. You can place a stop loss below the moving average line, adding some buffer space, because it is very common for the price to overshoot the moving average and show very deep pullbacks. And that is why you need to give your stop loss more breathing room if you choose such a pullback strategy. And if you enter the trade with proper confirmation and not being aggressive to enter the moment the candle pulls back to the moving average, then you can actually save yourself from the overshoot problem. Finally, a riding trend till the end is the best possible target. In case of an intraday trader, look to place the nearest resistance as the target. And for a swing trader, exit the trade either when the price breaks out of the moving average line or exit the trade when the market structure changes from trending to range or consolidation. So as you have seen, there are many different ways on how to approach the pullbacks. Now you can even use it with Fibonacci levels also. You can even combine the various tools to come up with even stronger signals. With that being said, it is always a good idea to backtest what you have learned to get a sense of how the strategy works in real market condition and see if it works for you.
السلام عليكم. لا تنسوا الإعجاب والاشتراك في القناة تشجيعا لنا لمزيد من العطاء والتألق.